Adani Wilmar, a stock which is creating a lot of buzz in the Dalal Street from the time this company got listed. So today we are trying to decode the company's business model, its growth prospects, and we are going to also understand what could go right, what could go wrong with the company in future so that you can take a wise decision of investing in this company. I am Varun Agarwal and let's get started. Before we begin, if you're new to the channel, please do subscribe and hit the bell icon, and you can join our Telegram channel where we discuss lots of exciting news, views and ideas on a daily basis. So Adani Wilmar is one of the largest FMCG companies in India. You can say that it is an oil manufacturing company and now it is transforming itself into a food and FMCG company. This company was started in 1999 as a joint venture with Wilmar Group, which is an international brand in agribusiness. The main products of this company are edible oil, wheat flour, rice, pulses, sugar, and they are now diversifying into various other food products. In terms of market leadership, it is the #1 edible oil brand in India, and it's a very popular brand called Fortune, which is used by a lot of us in our everyday lives. Other than edible oil, it has leadership in castor oil and also oleochemicals and specialty fats. So there are some products which the company supplies to the industries into its B2B business also. The company has 22 plants across 10 states, and now they are going to leverage this brand and diversify into several other products. Now let's talk about the management. The Wilmar Group's managing director and CEO is the non-executive chairman of Adani Wilmar. He has more than 40 years of experience in the agribusiness and he is the co-founder of the Wilmar International company. The managing director and CEO is Mr. Anshu Malik. He is a postgraduate diploma in rural management. He has more than 35 years of experience in the agri-business, food and agri industry, and he has worked earlier with Gujarat Cooperative Milk Marketing Federation Limited. He's been working with Adani Wilmar right from its inception since 1999. Now let's come to the business of the company. Broadly, you can divide the company's business into three parts. The first one is the edible oils business, the second part is the industry essentials, and the third part is the food and FMCG business, which the company is now expanding rapidly. In the first one, which is the edible oil business, the company manufactures products which are various oils like soybean oil, then palm oil, sunflower oil and various other products. In industrial essential segment, this is a B2B business where the company manufactures oleochemicals and other fatty products which we have discussed. In the food and FMCG segment, the company is now diversifying into other food products like wheat, sugar, etc. And they are also entering the FMCG products like soaps and other daily use items. Now let's talk about all the three segments in detail. In edible oil, they manufacture soybean oil, palm oil, sunflower oil, bran oil, mustard oil and various other products. Under this category, they have leadership in most of the products which they manufacture. They also manufacture specialty fats which are supplied to restaurants, bakeries, cafes, confectionaries, etc. to manufacture products like ice creams and other bakery items. In this category, they have brands like Fortune, which is their main brand, and other brands like King's, Aadhar, Bullet, Rag, Alpha, and several other brands. As you can see in the photos, they have various brands under this category, and a lot of brands are the market leaders in the category in which they operate. The second segment which they cater to is the industry essentials. This is a B2B business where their customers are various institutions. And under this category, they manufacture oleochemicals including stearic acids, palmitic acids and several other products which are used by the companies to manufacture different home products, personal healthcare products like soaps, detergents and cosmetics. Under this, they also manufacture castor oil and its derivatives which are used in the field of medicine, pharmaceutical, cosmetic and also aeronautical use. So this is a B2B business which they operate. The next segment which they are diversifying more into is the food and FMCG segment. In food, they have already ventured into before the IPO itself, like the staple foods like wheat, flour, rice, besan, pulses. So these they were already manufacturing before they came for IPO, and they are quite popular in some of these products. And now they are diversifying into products like soya value added products, soya flour, soya grits and soya flakes. They are also manufacturing ready to cook items like khichdi, soya chunkies, and in this category also their flagship brand remains Fortune, and along with Fortune they have other brands like Jubilee and Golden Chef. They have also ventured into soaps, hand wash and sanitizers, looking at the recent demand post-COVID. In this, they have launched a brand called Alive in 2020. Looking at the revenue mix, most of their business is a B2C business which comes about 72 of the total revenue, and B2B business comprises about 28% of their revenue. If you see the segmental revenue, edible oil is their main business, still constitutes about 84% of their business. industry essentials about 11.4%, and food and FMCG is just under 5%. So there is a long way to go under the food and FMCG business, and lot of new products can be launched and they can sell across different geographies to scale up this business. Now let's understand the industry in which this company operates. This industry has an impact of lot of global factors, like the Russia-Ukraine war has an major impact on this industry, whereas Ukraine is the largest supplier of sunflower, and because of the issue with Ukraine, roughly 50% of the sunflower demand has gone down across the globe. Now what happens when this demand goes down? People switch to other oils. Instead of sunflower oil, they start using other oils, and that's why India is importing from other countries like Argentina, Russia and Turkey, as there are issues in Ukraine. But one good thing is that post-COVID, the supply disruptions in this industry are going down, and the things are getting normalized. The rural demand still remains impacted, as the people in the rural areas are more impacted by the inflation which is around. Overall, if you see, around 35% of the demand in the FMCG sector comes from rural areas, and FMCG is witnessing a slowdown due to the inflationary situation which is going on around. A couple of trends which you observe in this industry are, there are more and more people shopping FMCG products online these days. So e-commerce is picking up, and a lot of people are buying from supermarket chains rather than individual kirana stores. So modern trade and e-commerce, these two trends are strongly picking up in the FMCG industry. FY23 is expected to be better than the earlier couple of years, as the monsoons are expected to be normal, as well as the COVID is going to be under control. The edible oil demand is expected to grow more because of couple of two factors. The first thing is the population is ever rising, and the per capita consumption of edible oil is also growing. So both of these factors will lead to increase in demand of edible oils. Looking at this chart, you will get an idea in the last 12 months or so, how have the prices of various products like palm oil, soya oil and sunflower oil risen in the economy. The per capita consumption of edible oil is expected to grow from about 15.1 kgs presently to about 15.5 kgs by FY23. So along with the per capita consumption increase, if the population also increases, it generates more demand for this industry. Now let's talk about the competitors of Adani Wilmar. There is no identical competitor of this company, and it is one of the market leaders in the edible oils in India. If you look at edible oil, the other companies who are manufacturing edible oils in India are Marico, then Ruchi Soya and Imami Agrotech. So these are the main competitors in the edible oil segment. The company also manufactures wheat flour, so it competes with companies like HUL, ITC, then Ruchi Soya in the wheat flour segment. When it comes to rice, pulses and sugar, the company competes with mainly the Ruchi Soya, as Patanjali's food products are moving into Ruchi Soya, so we consider both as one. Along with these companies, there are individual companies which are focused manufacturing single products, like the company competes with a lot of sugar manufacturing companies which are market leaders in their own field. So on a broad basis, this is a competitive landscape of the company. Now let's talk about a few of the competitors in more detail to understand the valuations of this company. So if we do a kind of like-to-like comparison, the closest competitor would be Ruchi Soya, which has a revenue of about 22,380 crores and EBITDA margin of close to 6%, ROCE of about 12%. Comparing with Adani Wilmar, which has a revenue of 54,214 as per the FY22 financials, the EBITDA margin is 3%. So EBITDA margin is much lesser than Ruchi Soya. ROCE is 21%, which is higher, and in terms of valuation, Ruchi Soya trades at a PE of about 40, whereas Adani Wilmar trades at a PE of about 113. And in terms of market cap to sales, Ruchi Soya is trading at a 2x valuation, whereas Adani Wilmar trades at about 1.7x valuation. So comparing it with the closest competitor, it more or less looks fully valued, and there is not much scope of further appreciation in terms of valuation. In short, there doesn't appear to be much margin of safety in investing in Adani Wilmar at the current valuations, looking at the present state of business. If the business gradually transforms into an FMCG business, then the comparison will be with companies like ITC and Marico, which have a revenue of about 60,000 crores, EBITDA of about 34%, ROC about 33%, and trade at a valuations of P22 and 5.7x market cap to sales. Marico has a revenue of about 9,500 crores, EBITDA 18%, ROC 44%, and trades at a PE of 55 with market cap to sales of about 7x. So to get these kind of valuations, the company actually has to transform itself from an oil manufacturing company into a full-fledged FMCG company. It would not be enough to just manufacture the products. The company should compete with all these big brands which are well established in this sector. They should take away some of the market share from these companies, and they should build a sustainable revenue over the next few years. And on top of getting revenue, they should have these kind of margins as well as return ratios. So when this kind of transformation happens, then Adani Wilmar will be eligible to get such valuations which the other FMCG companies are presently now getting. But looking at the present business of the company, if we try to give such valuation, it will be on the higher side. But the shareholders, which are quite positive about the company, who are quite hopeful that the company will transform successfully into the FMCG sector, may consider investing at the present level and take the risk of the business transformation which the company is undergoing presently. Now, what are the competitive strengths of this company? The company has strong parentage of two big groups, which is the Adani Group as well as the Wilmar Group, which is one of the two big business houses across the globe. They have very popular brands like the Fortune and the other upcoming brands of the company, and they have a very strong sourcing as well as distribution network. Sourcing network is also important in this industry, as the raw material has to be sourced from different countries globally, and if there is any disruption in the supply, the business of the company can get drastically impacted. Along with the sourcing network, the company has to have a strong hedging strategy. As there are a lot of currency fluctuations, supply disruptions, the company has to hedge their prices continuously so that their margins are not getting impacted. The company is operating with very thin feather line margins, like just 3% EBITDA. So if there is no proper hedging, the company's business margin will go for a toss. So they have a strong sourcing and distribution network. They have market leadership in the products which they manufacture, as we are going to see in the coming slides. They have huge scale of operations which give them a lot of operating efficiencies. So for some new player to enter this field and operate at this level of cost will be very difficult. They have technical know-how which is well supported by the Wilmar Group, and they have strong understanding of the business, and they also have strong understanding of the supply and demand dynamics. The supply and demand is also a critical decision in this business, as you have to understand how much is the demand going to be in the next few months, and you have to procure the raw material accordingly. If there is a mismatch in the supply and demand, the business may be drastically affected. So this kind of understanding develops over a period of time, which this company already has. The company already has diverse set of products in the edible oil category. So even if the demand shifts from one oil to another, the company is well poised to take that demand also. And now they are diversifying into different FMCG products which give them further diversification. So these are the different strengths which this company has. Now looking at the market share, they are number one in the edible oil segment. In fact, they have gained market share from 18 to 18.8% recently. They are number two in the wheat flour segment. They have gained market share from 3.5 to 4.7% in this category. They are number three in the rice segment. They have gained market share from 6.1 to 6.49%. So not only they are market leaders, but they are gaining market share. Now when we ask how are they gaining market share, the company's management says that the retailers and the distributors are more happy to keep brands which are fast moving rather than slow moving in such uncertain times. So this kind of uncertain scenarios generate advantages of big brands like Fortune. In the oils category, there are various oils like soya bean, sunflower, where the company has first leadership in soya bean oil, third in sunflower oil, second in palm oil, second in Worthmore oil, rice bran oil again number one, and mustard number one. So they are market leaders in almost all kinds of oils which they manufacture. What is the growth strategy of the company on a broad basis going further? The company plans to transform itself from an oil company to a full-fledged food and FMCG company. They will focus in diversifying their products into various categories. They will use their present brands, present distribution network to scale up their food and FMCG business very quickly. They will focus a lot more on e-commerce, so their share of revenue from e-commerce will keep growing. They will focus more on the modern trade, as people are shifting from buying from unorganized players to the organized players. So their focus will be on the modern trade. In terms of capex, they are doing about 1900 capex planned for FY23 and FY24. So there will be capacity additions, and the company is poised to grow through inorganic expansions also. They have reserved about 450 crores of cash to acquire certain new brands in the next couple of years, and the recent acquisition of Kohinoor Rice also was a key acquisition to scale up and have a stronger hold in the rice segment. So this is their growth strategy for going further. There is another initiative which the company has taken, which is called Fortune Mart. So in this, they are setting up physical stores which are selling their products. These stores are also acting as warehouses or supply depots for for refilling their products to the nearby dealers. So they have presently 33 stores which have more than 19,000 footfalls already. They have about 50% conversion when somebody enters into the store, and they are coming up with more than 100 plus stores at various geographies. So this is another smart strategy where you are getting directly to the customers as well as you are improving your distribution network. Another thing which they are focusing on is on e-commerce. So there's an initiative called Fortune Online where they have their websites and mobile apps, and they are serving presently in 25 cities, and the app already has more than 1.5 lakh downloads. They have received more than 29,000 orders in FY22, and the average order size is somewhere around 740 rupees. Online, the major selling products are atta, which is 14%, soap, which is 10%, soya oil, which is 7%, sugar about 8%, and the other products 44%. So like this, they are focusing a lot on the modern trade as well as on the e-commerce. Now, what are the risks? The major risk which this company might face, the geopolitical risk, as it's a global business, it depends a lot on the sourcing as well as the supply. So the geopolitical situations have to be normal and they have to plan their business accordingly. There is a lot of effect of inflation on this business. As the prices keep on rising, the companies either have to increase their prices of end products or they have to reduce the portion sizes which they sell. So when such kind of things are done frequently, there is an impact on the demand from the end customer. There's a lot of competition in the field which the company is entering into, which is the food and FMCG segment. So there have to be a very strong strategy to penetrate into this sector. And they also have to hedge their positions quite well, because it's a very thin line margin business. It's just about 3% EBITDA. So if they're hedging and all these things are not proper, then they may end up making losses. So these are the major risks which this company has to face. Now, after discussing the business, now let's analyze the financials of this company, starting with the Q4 FY22 results. Although the company says that we should look at them as a year as a whole, but still let's talk about the Q4 performance before we get to the annual performance. In terms of volume, they have grown about 16% year on year, and the operating revenue has grown about 40%. So you see there is a difference between the volume growth as well as the value growth. The major difference in this is because of the inflation and because of the prices which the company has increased. In terms of EBITDA, it has grown about 29% and profit after tax 39%. So compared to revenue, you see that the EBITDA has grown less. So this shows that the profit of margins have been impacted slightly. Segment wise, if you see, edible oil has grown at a revenue of about 41%. Earnings before interest and tax have grown about 42%, and the volume growth is about 23% in edible oil. So this segment has grown much better than the other segments. In food and FMCG, the revenue growth is 49%. The earnings before interest and tax have grown by 94%, and the volume growth is 33%. So food and FMCG is also growing pretty well. When you come to industry essentials, the revenue has grown by 34%, but the earnings have reduced by close to 94%. So this sector on a quarterly basis, it has not done so well. Whereas in terms of volume, there is again a degrowth of 11%. So this is some area where we have to closely look at in terms of performance going forward. Now let's look at the yearly results. Now in this slide, we are going to only talk about the FY22 results comparing with the earlier year. In terms of volume, they have grown by 8%. In terms of value, they have grown by 46%. So there is a huge difference in terms of value as well as volume. This is because of the increase in prices which the company has done, and the actual growth in terms of volume is only 8%. EBITDA has grown by 34% and profit after tax by 26%. Now again, you see a difference between growth in revenue as well as growth in the profitability. So this shows that the margins have reduced in this year compared to the last year. Now yearly, let's talk about the three different segments. Revenue has grown by 47% in edible oil, earnings before interest and tax by 26%, and volume by 10%. And in food and FMCG, the revenue has grown by about 38%. Earnings have de-grown by 116% and volume has increased by 34%. So in terms of volume, the FMCG segment is growing pretty well, but the profitability is not coming. Looking at the industrial segment, which is year-on-year basis, revenue has grown by 42%, Profitability has also increased by 57%, but there is no volume growth. The volume has degrown by 11%. So again, industrial essentials has become a gray area in terms of yearly growth also. So our main focus when we look at the growth of this company should be on the food and FMCG and industrial essential segments to take an investment decision, as this will decide the future growth of the company, and these sectors will also decide whether the company deserves the premium valuation which they are trying to get, comparing themselves to the other FMCG companies in the same sector. Now let's talk about the yearly numbers. Overall, the consolidated numbers, the revenue of the company has grown from about 28,000 crores to about 54,000 crores in the last 4 years. So the revenue has grown pretty well. EBITDA has grown from about 1100 crores to about 1700 crores, so it's growing steadily. EBITDA margin has got reduced from about 4% to 3%. Now we are looking at increase in the margin so that we give the company a re-rating. But here the margins have degrown because of the inflation and various other situations. So going further, we have to closely watch whether FMCG, due to the FMCG impact, the volumes should increase more than 4% rather than reduce. Profit after tax has steadily grown from about 300 crores to about 800 crores in FY22. Profit after tax margin was steadily growing from about 1.3 to 1.9, but it has reduced to 1.5% in FY22. So even if you consider just about 2% margin in profit after tax, still it is very risky to invest in such businesses. Although the nature of business is same, that it's a low margin business, but we as investors have to be very careful in investing in low margin businesses. In terms of equity, it has gone up to 130 crores post IPO. Reserves have steadily grown. They have increased from about 2,000 crores to about 7,500 crores in FY22. The borrowings are steady. The debt is under control. It's about 0.36 debt to equity, which is fine. They have about 2,700 crores debt on the balance sheet in the financial year 22. There is a sharp increase in trade payables to about 9,242 crores from 950 odd crores. So this has to be closely watched whether the company repays these creditors soon, and in FY23 it becomes normal. The fixed assets are steadily rising from about 3,000 crores to about 4,600 crores in FY22, and the inventory is in line with the revenue growth. So there are no red flags in the rising of inventory, about 7,700 crores. Inventory days are steady. They have about 58 days as inventory days, and inventory receivables have gone up from 1,500 crores to about 2,200 crores, which is also quite normal with the increase in the revenue in FY22. Debtor days are just 15 days, so there's no problem in the length of the debtor days. Cash equivalence has improved from about 1100 crores in FY21 to about 4500 crores in FY22. So the liquidity wise, the company is fine. Operating cash flows have always been positive. They have generated about 1160 crores of operating cash flows in FY22. Free cash flows have also been positive. They have generated about 624 crores of free cash flows in FY22. In terms of liquidity, the company looks fine. Now let's look at the shareholding pattern, which is again going to be interesting for this company. The promoters hold about 88% of the stakeholding even after the IPO. So there is a time period beyond which the promoters have to reduce this to up to 75%, which is going to happen sooner or later. So if they come with an OFS which is much lesser than the market price of the share, there could be pressure on the share price of the company. So this will remain as an overhang on the stock going further. The public holds about 9.6% and FII is just 2%. DII's share is negligible. So there is not much institutional holdings in the company, and the free float of the shares in the market is very less. So when the free float is less, the share price gives abnormal movements. So the investors have to be careful while investing in such companies. So you see a lot of times this company's stock is hitting upper or lower circuits because of less of free float in the market. Now let's look at the chart. After listing, the stock was continuously rising. It went up to more than 800 rupees, and it started hitting lower circuits, and it took support at its 50 days average, which is somewhere around 560 rupees. So if you are convinced with investing in the company and you are comfortable investing in a high PE stock, then you can consider investing somewhere around 500 to 550 range to begin with, and gradually accumulate the stock as and when the company's performance gets better and better. Other than this, the major support will come around 400 rupees for the stock. So this is about Adani Wilmar. Now let's discuss and summarize the thesis and antithesis points. In terms of the positives, the company has a very strong parentage from both the leading business houses across the globe. They have strong market leadership in all the products which they manufacture. They are in the top 3 in almost all the edible oil segments. They have strong brands which they can leverage to diversify and enter new product categories. They are poised to grow organically as well as inorganically, and they are already doing it by doing acquisitions like Kohinoor, and there are some upcoming other acquisitions as well. The company is transforming itself from an oil manufacturing company to a food and FMCG company, and if this transformation happens, then the re-rating of this particular stock is inevitable. Now let us look at the antithesis points. It's a very low margin business presently with an EBITDA margin of just 3%. Then FMCG, which the company is moving into, has intense competition with world global leader brands which are manufacturing extraordinary products in their own categories. In terms of volume and in terms of value, you see a lot of difference in growth in FY22. So you have to closely watch when the inflation subsides. You'll get to know the actual growth of the company when the inflation becomes normal. So you can compare in the next 2 to 3 years whether the growth is steady and how much growth the company is getting. And in terms of valuations, the present valuations are already discounting the future transformation of the company. So you should invest in the company only if you are convinced that the business transformation is bound to happen. So this is about Adani Wilmar. I hope you like the analysis. I've tried to make it very crisp as well as I've tried to convey the major points in the analysis. If you like it, hit the like button and share with your friends. And if you're new to the channel, please do subscribe before going and hit the bell icon. If you want me to make more videos on your favorite companies, please do comment the name of the company in the comments below. Thank you for watching and have a wonderful day.